Let us look at this illustration. A company purchased a non-current asset for 100,000 US dollars, and the non-current asset has 4 years useful life with no residual value. The asset is expected to generate 40,000 US dollars per annum for all the 4 years. The company will depreciate the asset using straight line method over 4 years for financial reporting purposes, but for tax purposes, the company will depreciate the non-current assets over 3 years. Let us assume that the tax rate is 30% each year. We were asked to compute all of this. We would get started with the computation on the next slide. I have summarized the previous illustration. Here, let us get started with the computation relating to financial reporting purposes. The first thing to compute here is the depreciation expense. The depreciation expense is the historical cost, and the historical cost is 100,000 US dollars, then minus the residual value or the salvage value or the scrap value, then divided by the useful life of the asset, which is 4 years. Solving for this, I have 25,000 US dollars as the depreciation expense. The next step is to compute earnings before tax or the accounting profit. We would get started with year 1 earnings before tax. The first thing here is to compute the revenue. What is the revenue? The annual cash flow that the non-current asset will generate each year is 40,000 US dollars. Then less the depreciation expense. The depreciation expense is 25,000 US dollars. Then I have the earnings before tax or the accounting profit, which is 15,000 US dollars. I need to compute the income tax expense. To compute the income tax expense, I will have to multiply by the tax rate. The tax rate is 30%. Solving for this, I have 4,500 US dollars. Recall that the asset will be depreciated over 4 years using straight line depreciation method. That means the depreciation expense per year will be 25,000 US dollars. The annual cash flow that the asset will generate is 40,000 US dollars. Then the accounting profit or earnings before tax would be revenue less the depreciation expense, which is 15,000 US dollars. So to compute the income tax expense, it will be the earnings before tax, which is this, then times the tax rate. The tax rate is 30%, then we should have this. Now, moving on to the computation for tax purposes. The first thing to compute here is the depreciation expense relating to tax purposes. It will be the historical cost of the non-current asset, which is 100,000 US dollars, then minus the residual value, which is 0, then divided by the useful life of the asset for tax purposes. Recall that we use 4 years for financial reporting purposes, but for tax purposes, we were told it is 3 years. So solving for this, that would be 333.33 US dollars. So the depreciation expense is this amount, and we agreed from what we were told here that the useful life of the asset for tax purposes is 3 years. That means the asset will be depreciated over 3 years. By year 4, the depreciation expense will be 0. So to compute the taxable income, it will be the revenue less depreciation expense, which is this. For year 2, it is revenue less the depreciation expense, the same for year 3. But in year 4, the taxable income will be 40,000 US dollars less 0, since the depreciation expense in year 4 is 0, and that implies that the taxable income in year 4 will be 40,000. To get the taxes payable, it would be the taxable income times the tax rate. So 30% of this is 2,000. 30% of this is 2,000 US dollars. 30% of this is 2,000. Then 30% of this is 12,000 US dollars. It's worth noting that if you add the whole of this together, that should give you 18,000 US dollars. Then if you also add the whole of this together, it will also give you 18,000 US dollars. So the total income tax expense across all the years is the same as the total taxes payable, which we agreed is a total amount of 18,000 US dollars.